Meet Sam. Sam buys plain white sneakers, paints custom designs on them, and sells them online for a nice markup. It seems like a great setup, but recently Sam noticed a problem. Half of the custom shoes have sold, but Sam's bank account is basically empty. The money has seemingly vanished into the business. To find the missing cash, we have to look past the bank statement and into the shoe boxes. We need to figure out exactly what Sam owns and what it's actually worth. This means organizing Sam's stuff into 3 specific buckets. First, the finished shoes ready to ship. Second, the shoes half painted on the desk. And third, the raw supplies, like the blank sneakers and unsealed paint, waiting to be used. Every item in these buckets represents cash that Sam has already spent but hasn't earned back yet. If we don't measure this trapped cash perfectly, Sam might be going broke without even knowing it. Let's focus on a single shoe. If Sam buys a blank sneaker for $50, you might think the cost of that inventory is $50. But in the world of business, that's only the starting point. This diagram shows how the shoe's value grows as it moves toward the customer. We start with the $50 price tag, then add the shipping fees to get the shoe to Sam, and the cost of the leather paint. Then there is the effort of actually making the product. The hours Sam spends painting and the electricity used to keep the studio lights on are necessary to turn that blank sneaker into a custom piece. We add these making-of costs to the total value. However, we don't include everything. If Sam orders a pizza while working or pays for an Instagram ad to find a buyer, those costs don't stay with the shoe. They are separate expenses that don't increase the value of the inventory itself. We only count the costs required to get the shoe to its current state and location. This is the only way to know exactly how much profit is left over after the sale. Now, Sam also sells large batches of identical branded t-shirts. The problem is that the price Sam pays the supplier for these shirts changes from month to month. If Sam buys one batch of shirts for $10 each and a later batch for $12, which price do we use when a customer buys just one? They all look exactly the same. For the unique hand-painted sneakers, it's easy. Sam tracks each one individually because each shoe has its own specific cost. This stack shows how we handle the identical t-shirts. Since we can't tell them apart, we often use a rule called first in, first out. We simply assume the oldest shirts, the ones bought first for $10, are the first ones to leave the shop. Other businesses prefer averaging them out. In this version, we blend the $10 and $12 costs together. This creates one consistent price for every shirt in the pile, no matter when it was bought. By picking one method and sticking to it, Sam ensures the profit numbers are consistent and honest, rather than just picking whichever cost makes the month look better. But what happens when things go wrong? Imagine Sam buys 20 pairs of chunky dad shoes, but then the fashion trend suddenly disappears. Sam spent $60 to make each pair, but now the most a customer will pay is $40. This comparison shows a vital safety rule. We must value inventory at whichever is lower, the original cost or the cash-out value. The cash-out value is the actual money Sam expects to have in hand after selling the shoe and paying for shipping. Because the trend died, Sam has to drop the value of those shoes on the books to $40 immediately. This records a loss right now, rather than waiting for the shoes to eventually sell. This keeps the business grounded in reality. Financial records cannot claim an asset is worth $60 if the market is only offering $40. Finally, a customer clicks buy, and Sam ships a completed, unique sneaker out the door. This is the moment the math pays off. This movement shows the final step. The value we've been tracking, the blank shoe, the paint, and the labor, officially leaves Sam's owned list and becomes an expense called the cost of sales. When we subtract that total cost from the price the customer paid, it reveals the actual profit Sam made on the hustle. This journey required tracking every cent, choosing a consistent method, and being entirely honest about their true current value. By mastering these rules, Sam can see exactly where the money is hiding and build a business that is built to last. Finally, a customer clicks buy, and Sam ships a completed, unique sneaker out the door. This is the moment the math pays off. This shows the final step. The value we've tracked, the shoe, the paint, and the labor, leaves the owned list and becomes an expense called cost of sales. Subtracting that total cost from the price the customer paid reveals the actual profit. This journey required tracking every cent of the creation process, choosing a consistent way to follow those costs, and being honest about what the items are worth today. By mastering these rules, Sam can see exactly where the money is hiding and build a business that is built to last.